Hello, everyone, and welcome. My name is Alice Turner. I'm the founder of a startup, Urban Tech, which is a technology-focused social enterprise based in North Hartford. I am also a track captain for Techstars Hartford. I am proud to bring to you the Investors Circle, a group of people who will share their insights, their wisdom, and their experience related to investments. I am also have the pleasure of introducing our moderator for this segment, who is Dorothy Adams, a board member of Capital for Change here in Connecticut. As with other sessions, I'm asking you to please put your comments in the chat, put your questions in the chat. We do have someone who's monitoring them throughout this segment. We will have ample opportunity to answer your questions. So we want to hear from you as we go through this. I, again, am proud now to introduce our esteemed panel and our moderator for the day, Dorothy Adams.
Thank you, Alice. And let's get right to it. We do have a fantastic panel today of investors, active investors all across the spectrum, and also connected to Connecticut. And so we will be starting off with just a little bit of introducing of folks. And just as background for me as well, Capital for Change is a community lender, so a CDFI, if you know what that lovely acronym means. Lending for affordable housing, energy efficiency, and urban microenterprise. But I'll confess, I used to be a venture capitalist and an angel investor. So that's why some of the terminology might be familiar if I dig back in the gray cells far enough. Today we have, I'll start with Esther. Esther, I think our paths crossed long ago at some angel forum. That's why it's ringing a bell. In addition to the Wellville Project, she is an author and an angel investor, a very successful angel investor.
Very lucky.
I believe you're invested in Square and Gridpoint, as to name just a few, which is really fantastic. Esther, if you could just start off with add anything else you want on your background and things that motivate you. Plus, what are your target deals? What do you look for, and amounts and that sort of thing?
Okay, I'll try to be brief but useful. I started out as a fact checker for Forbes magazine, and that's, I really think, the best training for almost anything, because you learn how to ask really tough questions and keep asking till you get the answers and not be afraid of looking stupid. And honestly, as an investor or as a startup founder, that's really, really useful. 25 years in the tech sector, I got more and more interested in healthcare, and then my journalist kicked in and said, well, why are we spending so much money fixing people who shouldn't be sick in the first place? And started to focus more on health and the social influences of health and how to keep people healthy, which is, it's not a lack of medical care, though that is also a problem. It's a lack of other kinds of care. It's maternal support. It's good schools. It's child care instead of child storage. So as an investor, after I sold my tech business, I'm an angel investor, and that is a blessing for me. It's not other people's money. So I feel free to make mistakes. I invest in things in order to learn rather than necessarily to make tons of money. I invest in enough things that I can get lucky, like with Square or Amada Health, or I'm also in what used to be Zipongo, which is food. I was on the board of 23andMe. So mostly I'm just trying to continue my education, and the 9 deals out of 10 average that don't really work out, they're the cost for the 10th one that works out great. And I'll come back to a lot of other things later, but that's me.
Thank you. That's and great to point out that 9 out of 10 ratio. That really hits home.
This is the challenge, because that's for me as an investor. For an entrepreneur, it's like you have to realize maybe your startup is an educational experience. It's not a winner, but it will make you so much more prepared for the next one. And I've several times invested in the second company of somebody who, quote, failed the first time around. They learned a lot.
Oh, that's interesting.
Yeah.
Next, let's dive in with you, Joanne, partly because it takes us up the investment cascade to where money is flowing from and to within from the big league with billions under management to those that are doing the smaller investments. Joanne, you have with Fairview Capital are doing amazing things in the investment advisor space, and I was particularly interested to hear your focus on diverse emerging managers and how you've been approaching that over many years. But first, just more on yourself and also, the kinds of things that you look for when you look at venture capital funds to flow money to, because this is just so everybody's following along. We've now stepped up the cascade. She's the one helping the big fund managers, get their money into smaller venture funds. So, Joanne.
Thank you very much. So Fairview Capital was started literally 25 years ago, which is really hard to believe. And it was started to because we wanted to be able to raise larger pools of institutional capital that would be focused on more diverse firms, which was not the case at the time. And of course, it's still developing. And so many of the initial firms that were in business at that time were regulated and licensed by the Small Business Investment Company, SBICs. And many of the investment executives at that time indicated that there was really a need to build bigger pools of capital to be able to address companies that were growing and that they did not really have the capital to really support them. So Fairview was founded based on partly that premise of growing and developing larger pools of capital, and also being able to invest in more diverse firms. So it took a couple years to raise the first fund from institutional investors, and for the institutional investors to realize that this was not. There was no desire for this to be called social capital, or to look upon it, in a way that, well, can we expect to have the same returns that we have with our counterparts, if you will? And of course, we said, absolutely. We're just broadening the opportunity set and providing more people to have the opportunity to grow successful companies. So we were able to raise that first fund. Most of our investors are public pension funds from around the country. And so from that first $100 million, we now have, as you indicated, that larger pool of capital under management. So when we look at the firms that we invest in, we of course invest in venture capital, but we invest in newer funds that are building. Funds that are investing in all types of companies across the country. And we have been able to do that and build diverse firms. And in that way, those funds and those firms are investing in entrepreneurs that are diverse in all areas of technology to regular buyout funds, whatever the types of companies may be. But it's been very critical because we have to be able to have capital that is there for growing companies, because when you start a company, and that's critical, and you need support, you also need support in growing the company and creating more companies, and also being able to look for talented people to help to run those companies. And so Fairview has been doing that over the course of 25 years. And so that's who we are. We're headquartered in West Hartford, Connecticut, but our investors are all over the country.
Yes, and indeed, possibly even global if you've got pension funds, right?
Yeah.
Yeah. And now that we come back down a level to the venture field, and we're lucky to have Doug here today, Doug Roth from our very own Connecticut's venture arm called Connecticut Innovations. And so Doug, here, let us know what CI is up to these days and anything else about your background you'd like to share.
Sure. Thank you, Dorothy. So, yeah, as you mentioned, Connecticut Innovations is the strategic venture capital fund for the state of Connecticut, and we invest primarily in early stage tech and life science based businesses. And it's about an even split. On the life science side, we focus on things like diagnostics, therapeutics, medical devices. My focus is on the tech side, and it's all sort of those tech acronyms, ad tech, fintech, insurtech, which is a big one with all the insurance companies in Hartford, advanced manufacturing, cybersecurity, Internet of Things. We really are, I'd say, technology agnostic and stage focused, really focusing on those earliest stages of company formation. So typically that ends up being seed stage investing for us. Generally our initial sort of investment size is anywhere from $500,000 to $1.5 million. We're looking to put $4 to $6 million to work in any one company. We're generally pretty active, taking board seats and trying to support and help our companies in any way possible. And we like to invest in a syndicate, and that syndicate can take the form of angels, family offices, other venture funds, or the strategic venture arm of corporate. And we've worked sort of across that spectrum. Sort of a little bit about me and sort of what motivates me and you know why I got into this, why I find it super exciting, and perhaps why I may be helpful to the companies that we invest in. You know, I've got a background in engineering. I like to build things, and you know, when you're working with entrepreneurs, certainly at the earliest stages, you're helping them build a business, build a product. That it's really motivational. Later in my career, I got an MBA, and sort of that pulled together a lot of different pieces of the business world: finance, marketing, accounting. I worked for a number of years in management consulting, helping both startups all the way up to Fortune 100s with strategy. And you know, there's really two parts to these very young businesses. There's strategy and execution. I think the execution is far more important than strategy, but you still need to have a decent strategy around what you're doing, who you're doing it for, and how you're going to bring it to market. And then finally, I worked for a number of years in sales and business development, and I think that you know, particularly for young entrepreneurs or entrepreneurs of young companies, you're always selling. You're selling to investors. You're selling to, you know, get that first dollar of revenue. Quite frankly, you're selling to talent to get them to, you know, take a leap and join your company. And so I think having a really good understanding of sales and sales techniques has been pretty helpful as well. So.
Thanks, that's great. And I think we've got a theme already starting, which is the use of the different terms about stages, early stage, seed, and you know, how does that match up with a company, pre-revenue, post-revenue, you know, the different risks around that. I would love to hear both, I think, Doug and Esther, your comments on what are the different kinds of you know, approaches to the very early stage, seed, pre-revenue. What are your preferences, and you know, what do you see as working well for the entrepreneurs?
The short answer is it depends.
Yeah, I agreed.
Some examples then, some great examples.
Yeah, I mean, it's like from the company's point of view, the less money you take in early, the less you dilute your company. At the same time, I see so many entrepreneurs who are kind of stingy, and they end up with inadequate resources. They end up running out of money, and then they have to make bad deals. From the startup's point of view, probably the most important thing is to have investors that really are aligned with your mission. They have to share your DNA, because ultimately the metabolism takes over if you don't protect that initial mission. And they want you to, the investors with Elizabeth Holmes, for example, were horrible investors. They were enabling fraud because they didn't understand the business and they wanted it to grow exponentially. I mean, that's an extreme example, but money is not the same. It really is different depending on who it comes from. So rather than focus on the amount, which should be a bit less than you think you need, a bit more than you think you need, focus on who's giving it to you, what are the terms, do they add to your, if you're 4 dudes from Yale, white guys, at least get a diverse investor pool. And it's just be thoughtful about where the money comes from and how it's going to influence you, because no matter what the term sheet says, the source of the money, and especially the follow-on money, is the one who writes the rules.
Doug, you want to add to that?
Yeah, no, I agree with everything Esther said. I think that also I would add, and I certainly don't mean to sort of overly simplify what it is that investors do, and certainly entrepreneurs, but I've just found that there's a lot of almost cliches that really kind of capture a lot of important lessons and elements of all of this. And one is that, raise more than you need, because you'll end up needing more than you think, right? We've found that when entrepreneurs come up a little short, I get that dilution's super important to founders, but when you come up a little short and have to raise, let's say, money under duress, you end up probably getting more diluted than had you raised a little bit more at the onset. The other sort of corollary to that cliche is that it's a lot easier to raise money when you don't need it, and it's a lot harder to raise it when you do need it, right? When you're really on fumes, that's not when you want to have to be talking to, introducing yourself to investors. And just to comment on sort of the stages, pre-seed, seed, Series A, and so forth, I think, it's helpful. Those are helpful terms, and there are some general rules of thumb about how much you're raising, how much equity you're giving up, what sort of business milestones you likely have achieved at each stage. But as Esther really said, it depends, because on the therapeutic side, companies can have raised tens, if not hundreds of millions of dollars, and they still don't have $1 of revenue. But if you're a SaaS software company, you should be able to show some early revenue with very little money raised. I mean, it just doesn't cost that much these days to write software. With between the cloud and so many other lower cost platforms with which to launch a product. And so I think that unfortunately, companies raise capital, and they get kind of boxed in by these terms. And if they're raising money for the 3rd time and they haven't achieved certain milestones, it doesn't necessarily mean that they're failing. But given the terminology of seed, Series A, they may not fit well into a box, and that can sometimes be problematic, and it's unfortunate.
There's some great themes in there, especially the don't try to raise money or wait to raise money until you absolutely need it, because it's the same in the debt world, the banking world. That's the worst time to be raising money. But there's another theme that was coming up, and Joanne, I'd love your thoughts on this, because you're looking at, you put money into venture capital firms and their funds, and there's the challenge of they're picking portfolio, keeping some, as they say, powder dry for round 2, 3, 4, whatever, A, B, C, D. Where do you see the VCs get into trouble?
Well, we try not to invest in VCs that get into trouble.
Right. What are your red flags then?
That's the first thing. But what I will say with respect to venture capital firms, and we do a lot of investing in firms that focus on Series A deals. We do later stage venture, but we do a lot of venture firms that are focused on seed and A. So many of them, I think the positive things, many of them have a lot of experience. We make sure that we invest in firms that have experience in the areas in which they want to be able to focus. And that's really, when we're making those decisions, that's critical, because we want to make sure that they can build the portfolio accordingly. The other thing is the good venture funds, and that's at all levels. They have a good relationship with entrepreneurs, and many entrepreneurs look to do business with certain venture firms, and especially with respect to their specialty. So that's another very critical piece. So who you pick, or who you want to approach to do business, is very important, because you want to approach firms that have a particular expertise in the area that you are looking to build your business. And then I think the other thing is, for most venture funds, the Series A funds, and by the way, some of the venture funds now have also built a follow-on fund, so that as those funds in their portfolio are growing, they also have the opportunity to invest in certain companies as they grow. So that's something that's starting to happen now. So it's not always passing that deal on to a later stage fund. Often they can keep those funds right where they are. I think the other thing that's important with respect to venture is when you are looking for a firm to do business with, you want to make sure that you're in good company. Other venture funds with certain types of companies that are in their portfolio, are they going to be able to allow you to meet others, to introduce you to others, make sure that for next stage of capital that you need to have, they're already a part of that process, because the venture firms actually want to see you succeed. There's a mutual interest in that.
Yes.
So
yes.
I think the work that you do, the research that you do when you're approaching firms is very important, and the interpersonal aspect of the business should not be underestimated. You don't necessarily want to do business with everybody, and so you got to pick who they are. So I mean, we have thousands of companies in our portfolio, and some companies that were just startups, and now one of those was Zoom. It's in our portfolio.
All right.
You know what I mean? SaaS, back when it was new, and you had a team that was building companies like that. So it's a matter of following the companies. We have young entrepreneurs that are looking to build and do different things, but you got to do your homework and make sure that you find firms that really meet what it is you want to be able to do. And Fairview, we do co-investing, and we also invest directly in companies in the state of Connecticut. And in fact, we have done a couple of deals with my colleague right here, Doug. So that's also important. And we've got someone who specializes at Fairview, who's Alan Matamana, who was a direct deal guy himself. So so we do that as well, and invest in a variety of companies in the state of Connecticut directly.
Great. That's
and if I could, Dorothy, I just want to Joanne mentioned something that I think is really, really important, and I'd like to just highlight it in a slightly different way. And that's, I think the entrepreneur, it's really important for them to be looking at the firms. Money isn't just money, right?
Mm-hmm.
They need to pick where that money comes from. And I think not just looking at the firm, and this is kind of a way of thinking traditionally more with like lawyers and consultants, and that's pick the partner, not the firm. And I think that's super important with respect to venture investors as well. Don't just pick the firm. You're going to have a relationship for 3, 5, 7 years with the partner who's leading that investment from that firm. And you want to make sure, there's good chemistry between you and her, and that you want to make sure that she's an expert in that field, and that she has value to add beyond just capital, because you can't unwind that relationship. And you're in for the long haul. So it's really important, not just at the firm level, but at the individual level as well.
Great point. Yeah, Esther?
So everything is true, and there are a few more points to think about. One, that partner that you love so much may leave, and that's important. Who are the other partners? Second, and this should be very familiar to people in healthcare. You think, well, they're motivated to save money but the reality is, if you're working with a large firm, they don't care about all their portfolio companies. I mean, just as I talked about the 9 that don't work versus the 10 that do, with the venture firm, the numbers are slightly different, but they have their orphans too. And, just be careful who you work with. Sometimes, they'll sacrifice one of their startups and sell it to one of their other ones, and they will work the price down by bad mouthing it, and then the company has no choice but to get acquired by this. They become a body part that gets wrapped onto something else in the portfolio. I don't mean to scare you, but it's really important to do due diligence. But your major point that they bring so much more than money. I mean, as an angel investor, I spend a lot of time editing people's decks. That's not what your Series A firm is going to do for you, but it's going to help you find a head of sales and marketing that would never join this company except for the VC introduction. They're going to, host you at their CEO summits. They're going to introduce you and sponsor you. And so the company you keep ends up being really important.
Yeah, and actually just because I heard both Doug and other comments on co-investing, does anybody have any horror story example or positive example of what happens when a mix of investors come together in a deal over time, and how does that play out sometimes? Anybody want to jump in on it?
I have lots of horror stories and no names. Everything from, we did this deal, to my guy needs to be on the board, to, for whatever reason, basically making it impossible for the company to raise money from anybody else, and then the venture firm itself gets a bargain. It's
a nasty world out there in there. Yeah, it's a nasty world out there.
I mean, most of them are great. And then in the other direction, they're the ones that kind of force you to employ sleazy marketing practices. And, Ubiome, which ended up basically, they didn't commit kind of technology fraud like Theranos, but they basically billed insurance for things that really were not billable. Mm-hmm. And I attribute that to the investors who just said, we need another quarter. And exponential growth should not be your purpose. Your purpose should be honorable profits and serving the customer.
Yeah, to dig a little deeper onto what are the things that as investors you say, no, I don't want to go anywhere near this deal. Are there, in particular, one of the questions is about what amount of traction, revenue traction, is something that you require as an investor?
Who are you
Or
asking?
I would
Sorry,
say Doug or
go ahead.
Esther, or, and then we'll, Joanne, as you've done, the co-investment side, you can jump that on too.
Well,
Yeah, so, yeah, go ahead, Joanne, please.
no, please, go ahead.
And maybe this is a good segue into Joanne and Fairview, because I know that their direct investments, they are generally a little bit later stage than CI. So CI, we are comfortable investing in pre-revenue companies, and in fact, we have what we call a proof of concept fund, which we'll do even earlier. And as the name would suggest, it is proof of concept. We're trying to help fund the completion of a minimum viable product, and maybe the running of those early pilots to see, is the management team, functional? Can they work together? Can they get something done? Does the tech work? Can they get an MVP built and get it in front of a few early users to see how do they use it? Does how they use it match their expectations? Are they willing to pay for it? And all of that is to figure out, are they going after the right market, the right use case, and what is sort of the pricing strategy and structure? And you need to figure out all of those things before you generate $1 of revenue. And then sort of that next round of capital, you're hopefully generating some revenue and then figuring out how to turn revenue generation into a machine, into a repeatable process. And that's usually like the thesis around a Series A investment round, is that you're providing the capital to accelerate that machine. You've figured out the machine, and now fuel into the engine to turn it on and get it into gear and really roaring. And I don't want to speak for Fairview, but my understanding is that that's when Fairview would then come in as a direct investor.
Joanne, you
So-
want to add on that, or?
So that is correct. Because when we do our direct deals, and as you say, our investors are primarily institutions, we are obviously in the business to make sure we return capital and appreciably, by the way. So with our co-investment program, that's exactly correct. That's what we do when we're doing direct deals. As it relates to our fund business, we invest in very early stage funds, and they, as I said, they do the gamut. But I think it's very important, and Esther indicated this, is that this business is a people business, and we are first and foremost investing in people. Because if you're investing in people who are not honorable in whatever way, as an investor, certainly as an entrepreneur, as well, and the people that you interact with, that comes first. The integrity piece has to come first, because you are, as an entrepreneur, you're investing everything. Your thinking, your hopeful development, everything that you want to be able to accomplish is based on decisions and people. So in this business, you've got to be able to make a good judge of people. You've got to be able to understand the reputation. And also, to Esther's point, the venture fund may have an excellent reputation, but you also want to try to pick somebody in that venture fund that meets your particular approach, personality, and their expertise. So it's very important, the people part of this, not really just about money, because that relationship will last you for 10 years, really. You said 7, but sometimes it's many more years.
Longer. Yeah.
And then if you're looking to do another company, you're looking for an exit, obviously. You want to make sure you're dealing with honorable people.
Yeah, and the two great themes you brought up. One is exit issues, and we'll put that one to the side, but that is something to keep in mind. But also the people side of it. I remember back in my day, a red flag was a single person, solo person coming in saying, "I've got the greatest idea." And when you ask them about, "Hey, who are you working with?" They're like, "I don't need to. I can do this all myself." So Esther, jump on in there.
I totally agree with Dorothy. That is a huge red flag. to the extent possible, I invest in teams and not individuals, but I invest in people, not the idea, because an idea without people to carry it out is worthless. And but I don't wait for revenues. I mean, again, I have the luxury of investing early at very low prices versus later at more reasonable prices. To me, one of the biggest red flags is I've always wanted to be CEO. What I like to see is there's this problem and I want to solve it. I have some inside knowledge, whether it's my own experience or I had a cousin or I worked on this at school and then I went and worked in the industry, so I know it's broken and I can fix it, as opposed to I'm a college student with an idea, honestly. And I'm also not wedded to being the CEO. I might be the chief science officer because I want to solve this problem. I want a good CEO that will work with me to help build a company that will deal with this problem. Whatever they tell me, whether it's revenues or the product, I don't really believe, not because they're not telling the truth, but because they need to focus on the problem and be willing to change how they're going to do it, what their product does, that kind of thing. They need somehow to understand the problem. And, I remember somebody, it was about something to do with families. And this is like a 24-year-old guy. And I asked him, when was the last time you talked to your parents? And
That's great.
And he came, and I was right. He came back 3 years later and he had started something for recent college grads, and it was perfect for him.
Yeah.
But
yeah.
I mean, again, I also have the luxury of, I don't invest in something that I think is going to make a ton of money, but is fundamentally not interesting.
Yeah.
I invest in things, and this is very personal, for which I have a passion. One more thing, the message to people raising money is, for you, this is your baby. It's got to get funded. For me, the default is no. And so when people don't invest, it's not rejecting you. It's, you may be great, but you're not a fit for my criteria. You're not a fit for my current interests. And so it can be really depressing getting these no's or getting no response all the time. And I try and be polite and just say, I'm sorry, this isn't where I'm focused. But, there is someone out there. If you and your idea makes sense, there is someone out there that's right for you. But don't talk to hundreds of people. Find the ones that are really interested in what you've got. Try and get a warm introduction, because, all of us here, we get hundreds of emails. I get 650 emails a day. They're not all pitches, but,
Yeah.
It's much more interesting to write something that actually betrays some knowledge of the person you're writing to and why they should be interested. And if you can't find anything, then don't waste their time or your time. Be more focused. And that's sort of a sign that you know how to market effectively. You're not just spraying it out, but you actually are looking at who the customer is.
And just to zoom in a little bit more on that, based on some of the questions that are coming up, that is to understand what, the balance between the amount of money that you want to invest and what results in terms of the percent of equity you are aiming for, because it comes wrapping around that is the subject of valuation. And I know we will not have time to cover valuation in only a few short minutes, but I remember trying to explain this, that the VC or the investor has to be at the valuation of where it is now, not the valuation of what it will be in the future, because we ride that together. So Doug, if you wanted to jump in on valuation and the percent of equity, discussions that you end up with, talking to them about.
Yeah, and I think this is clearly another one where the real answer, unfortunately, is it depends, but that doesn't make an interesting discussion. So I will share some other thoughts, and I think that you do have to strike a really appropriate balance. Obviously, you're about to enter into a partnership with the entrepreneurial team. And so this is like in economics and game theory, this is a multi-step game. It's not a one-step game where you can be brutal and then you part ways. We're entering into a relationship, so I want to make sure. I hate the term win-win, but it really does need to be win-win. You can't invest at too low of a valuation, taking too much equity, because then you're sucking the incentive out of the founders and the management team. But you also don't want to invest at too high a valuation, because if they can't achieve certain milestones before they need to raise the next round, and not just reach but exceed the post money of what you've just invested in, then that causes problems. So I try and have discussions with the entrepreneurs as we're discussing terms, that I'm not really interested in pre-money. What I'm interested in is post money. And so if we invest and it ends up being a post money of $10 million, are you really a $10 million company? Probably not. And so it's going to take some work to get there.
Yeah.
How much, right? How much work, and how much of the capital that you're raising today will be burned to get just to grow into the valuation? Because then you obviously need to make sure that you grow beyond the valuation. And so I think by reframing kind of that valuation exercise, it's one little step to make sure that all parties are trying to achieve the same goal. I mean, let's face it, at the end of the day, if it's a wild success, whether you overpriced it at 10 million or underpriced it at 6, you sell the company at 200,
Yeah, I mean, why
right?
waste that time haggling on that? Yeah.
Right.
Yeah, no, that's absolutely, yeah, that definitely covers that. And it's also thinking about the exit, which is, as we've said, many years down the road, and lots of things can happen along the way, things change. So yeah, you got to have the flexibility, for additional rounds if you need it, that sort of the long-term approach. I do want to have a little bit of time to address one more topic. It's very well known that out in the VC world, there's less than 5% of capital has been invested in Black-led companies. And I would love to hear from Joanne and others, why did that happen, and what can we do now to change that and have money flowing to people of all, people of color as well. So Joanne, if you're.
Oh, you were saying, I'm sorry, you said there is not enough money going to, what was that?
Well, there's some, I think I saw a report where some number lower than 5% of VC funding goes to Black-led enterprises.
Yes, that's true. That's very true, which is one of the reasons that we founded Fairview in the first place, to begin to build a financial infrastructure that would be able to address those issues. Huh? Oh, my husband, I'm on a thing, there's a bear in my backyard.
Oh my gosh. There's Connecticut for you.
There's a bear in the backyard. Oh my.
Lock the door, stay inside.
Better you than me, because I'm camping tonight.
I completely lost my train of thought. But anyway, the truth is, and I think this is very important, we had to be able to build investment companies that would be able to look much more broadly at the opportunity set, which would include people of color, male and female, and women in general, as entrepreneurs. So it is the case, and that has been the case at Fairview, that if you have people of color involved in running the investment companies themselves, the venture capital companies, they will be able to find opportunities for people of color. And in addition to that, there's going to be a broader reach across the landscape. So that's just a fact. And so we have been able to do that. And as a result, more capital is beginning to flow in that direction. Now, I will say when we started Fairview, there were the funds that are basically Black managed or minority managed, and more broadly speaking, were more on the buyout business because you had a lot of talent, Black talent in particular, coming out of the investment banks. And so therefore, they had the background and to be able to build buyout funds. And so that was the first group that you saw and Fairview saw in terms of them starting. And many of them came to Fairview talking about they had successful careers in other areas and wanting to start buyout funds. Now, I'd say over the last 5 to 7 years, we have seen movement in the area of venture. And we have been able to see a whole lot more diversity in the venture area. And in that area, we have been able, this is sort of Black, Hispanic, and women. We have now seen those funds grow and develop. And I would think that in the Fairview portfolio, we have a very good number of venture funds, new venture funds that are focusing on diverse entrepreneurs. And that is, of course, critical to be able to really build in mass, larger pools. And that is happening across the country. So that is, that's very exciting. And also, and not only that, it's very important for, as much as we don't really want to acknowledge it or admit it, but we have to realize that brains don't have color. They're not designed in color.
Yeah, they're just gray.
So we've got to realize that and begin to say, oh, this person's an engineer that has this, and this. And oh, by the way, he's a Black man. So can he be as good as? And so those are the things that you have to begin to really deal with, change, and realize that as long as the opportunity is there and people have the ability to take advantage of that opportunity, things will continue to change. And that's true. And that is also true with the newer firms, venture firms that have been developed and are growing, but it's also true with the experienced venture firms, because we have a big portfolio where they're also looking at diversifying their investors. I mean, I'm talking about the venture capitalists themselves and bringing in people. And that's important because then they will diversify their portfolio. So it takes time, but it doesn't just happen. It has to be proactive so that we can see change.
That's a great point about that being in part. Yeah, Esther, anything you've been doing with those barriers?
I mean, as you can probably guess, I don't work with spreadsheets a lot and, assign 3 points to this and 5 points to that. But if someone's Black or some other minority, it's a real positive in my book, partly because I have a network that I can use on their behalf. I mean, the point of venture capital, if you go to the stock market, your job is to pick companies that are going to go up. But if you're investing, especially as an angel and also as a VC, you can increase the company's chances of success by not just with your money, which is fungible, but with your connections, with your ability to put them in touch with other people, connect them with customers, find board members. The other thing I do, I will send people their decks back and say, how come there's, all the people in your deck are white? And, whether it's their customers or their staffs or their boards. And that's a clear negative to me because they're not addressing the world at large. They've got blinders on. And to some extent, I don't invest in these companies, but I hope that, that message gets through and spreads.
Thank you. Yeah, that's good. Doug, did you want to add anything on that point, or?
Yeah, I would just say that
engineers are typically white.
Yeah,
white guys.
yeah, but I'd like to say that CI I believe has got a really solid track record at investing in companies that, across minorities, across genders, and across sort of immigrant founders as well. And so I think we've been pretty proud over the years. We've been doing this for about 30 years. I think we've got a decent track record there. The fact that we have purposely created some very, very early stages, I mentioned proof of concept investing, super early, basically this is $100,000 investment. So, we're able to go down to that earliest stage of company formation when, entrepreneurs, they know no boundaries, right? Anyone can be an entrepreneur in any geography from any walk of life. People are creative and come up with great ideas, but not everybody's connected. Not everybody has, certain Ivy League pedigree or whatever. And so they may not have a network of high net worth individuals. And so, I think part of having a proof of concept investment fund allows us to help fill that part of the capital structure, capital cycle, and provide funding at those earliest stages, the valley of death, if you will, and help companies kind of get through those proof of concept and get to a point where the business, as well as the team that is being built, can start to stand on its own and attract capital. And then I think the last piece I'd mention is that, we try and go to where entrepreneurs are and not just, again, without boundaries, recognizing that entrepreneurs can be anywhere. We try and get engaged at down to the university level, and engage with the undergrads who will be, the future entrepreneurs, and not just go to, big conferences in fancy cities, but go to where the entrepreneurs are themselves. And we've done events in Stamford, Bridgeport, New Haven, Danbury, Hartford, across the state. So hopefully by increasing the deal flow from a diverse set of companies and founders, you increase the chances that you're also going to be investing in them.
To dig one layer more, yeah, go ahead.
One more comment to this point of diversity. The other piece that's very important, and I think this is the case, I would think for Doug and Esther in terms of their years of experience, Fairview purposely built we were focusing on diversity when we started, but we built a diverse firm in the first place. So, and that's very important as well. So as we are out and about all over the country, we have diversity that's a part of our team in every single position. And Fairview was founded by 2 Black individuals. And the organization, if you look at our website, it is a diverse firm of everyone. And that's very important because it's also an issue of trust. It's also an issue of who are you and what are you trying to accomplish and how much can we confide in you? Because we say, like everybody else, we say no more than we say yes, but we can be trusted to provide good advice and focus in terms of what you want to be able to do in the future. So we're not going to just say when you come in, okay, thank you, good luck, and goodbye. We still say thank you, good luck, and goodbye, but in there's a lot of advice, and they're dealing with people they can trust because they see the type of firm that we have built, and they know what we went through to build it. And that's very important when you're talking about this subject. It's not just a small issue in this country. It's a huge issue. Yeah. And we have to admit that and realize what has to happen.
Well, and on that point, just because on the recent Reset community call, talking with entrepreneurs, I heard that several say, look, I'm not able to fail. I can't afford to fail. I can't afford to not work because I have no savings. So the whole racial wealth gap issue, how is, when you're looking around and subtly, oh, well, this young white guy, he's going to dedicate all his time to this thing and not work on anything else, versus maybe a young African American guy who says, hey, I got to keep going with work because I can't, I don't have that pile of family wealth.
Yes, there is that inequity, but there's that inequity in general. And I think the bigger point is to be able to have a belief system that you believe that I can succeed. You see my background. You may have zero. That doesn't necessarily make a difference if you are looked upon as being someone who has a background and they can put together whatever the elements are to build something. But your point is correct. There are going to be those inequities in the business formation process in general. And that's not the biggest point. The biggest point is don't limit my access.
Right.
Allow me in to make the case. When you make the case, they're going to get a lot of no's, but be willing to provide advice. We provide more advice at Fairview than you can ever believe. And that's part of what we do as well. Many of the partners of Fairview do, have some things that they do individually with entrepreneurs. So, and that's important. But trust is very important, and we should never, ever underestimate that.
That's a great summary thought. And so as we're wrapping up in the last couple of minutes, just wanted to give folks a chance to add anything else as a message to the entrepreneurs in the audience, as they're starting to look at ways to get financing for their ideas. Doug, you're unmuted, so I picked you. Oh, no, your sound just went.
Is that
Now it's
There.
back there.
excellent? Yeah, no, I would just very quickly just say, I think there's kind of two big things entrepreneurs need to think about. First is, do you really, really want to take other people's money? Because it comes with strings attached. It comes with, some element of loss of control. And then once you've decided that you absolutely do, and you believe your business warrants it, then it's just make sure that there is really strong alignment between, your vision and goals and timeline for your business and the source of capital, and what that source of capital expects for a return over a period of time, and so forth. Because it's a relationship that you'll be entering into for a long time. And if the two parties are in conflict or not aligned, it is probably a bigger problem than had you not taken the money in the first place.
Yeah. Esther?
I want to give two contradictory pieces of advice. And the first one is, you're going to get so much advice from me, from everyone on this call, from investors. And your job is to listen to it all and then figure out which advice to follow, because it's going to contradict everything. And the second is the story of the two Elon Musks. And I have 1 minute left to tell this story. There's the Elon Musk at Tesla, and he's kind of out of control. He tweets all the time. He gets in trouble with the SEC, a real maniac. And he runs that company. He controls it single-handed. Then there's the Elon Musk at SpaceX, and he has a partner there, Gwynne Shotwell, and it's well run, it's well managed. I don't know what happens there, but I'm sure she sits and vanishes. Elon,
It's great stuff.
yes, like everybody needs, ideally it's your co-founder, but you need someone who will tell you when you're behaving like an idiot, who has your back, not someone who wants your job, but someone who wants you to be the best you can, and where you trust each other. And I have that relationship with my CEO, Rick Brush, that we don't have like a contract about who gets to decide or how many points. It's like, if we don't agree, there's something wrong. We need to, we're two sides of that same leadership, and each of us can go outside and sort of look at the team from outside, and we keep each other balanced, and it's a wonderful relationship. And I had a previous relationship like that with another CEO for my tech company find somebody like that, because they will keep you from making stupid mistakes, and they will support you and you can support them, and it's amazing.
Yes, great words. And that's 3 o'clock. We should be wrapped up now, I guess. And thank you all for participating today. I know it was very helpful for all in the audience. It's not very often that you get to hear the different perspectives and the time. I know access remains an issue. Being able to talk to prospective investors is hard to do, hard to find. So I know this is a very worthwhile conversation for everybody today.
Thank you, Dorothy.